Let's continue with our discussion of recording accounting transactions and talk specifically about these transactions and the accounting equation. Remember that all accounting transactions must be recorded in the accounting information system. That's its job, right? So to understand the nature of recording transactions, it's probably best for us to go back to that fundamental accounting equation, or the balance sheet identity. And so that's that one that we've talked about several times. Assets are equal to liabilities plus equity. So what this equation is telling us is that a company's assets must always equal the sum of their liabilities and equity. So that means that anytime you make a change to the equation, it has to be accompanied by a second change in order to be true to this equation. So what that creates then is this dual nature of accounting. So since every accounting transaction has to affect at least two accounts, that gives us this dual nature. And that's what this requirement is called. So if a transaction increases an asset account, for the accounting equation, assets equals liabilities plus equity, for that equation to stay in balance, the transaction must either decrease another asset account, so everything is happening on the left side of the balance sheet, or it increases a liability or equity account. So let's take a look at some examples of how accounting transactions affect the accounting equation. So here's our first one. We've got Circle Films, and they are receiving $15,000 in cash. So that means that assets are increasing because cash is an asset. Its equity is also increasing because investors have contributed cash for some ownership stake in the company. So more specifically, Circle Films common stock is increasing. So that's what you're seeing at the bottom of this slide. So now let's continue with Circle Films, but with a separate transaction. Now let's say that they're going to exchange one asset for another asset. So they're going to exchange cash for equipment and supplies. So both assets are increasing and decreasing by $10,000. So they're paying $10,000 cash for $1,000 in supplies and $9,000 in equipment. So the net effect is no change in total assets. Let's look at another example. In this third one, Circle Films is going to receive cash, so that means that assets are going to increase. But unlike the last one, where everything was happening on the asset side of our equation, this increase in assets results from filming a wedding. And so an inflow of assets from providing a service is revenue. You should recall that from when we talked about the income statement. So revenues increase net income, which in turn increases retained earnings. So as a result, their retained earnings, which is part of equity, is increasing. And so that is what balances our equation. Let's look at another example. In transaction number 4, Circle Films is again receiving cash from a customer, so assets are increasing again. They're getting a $2,000 deposit. But it's a deposit, so that means they haven't provided the service. So they have an obligation. It's not revenue yet. They've got an obligation to the customer, so that results in a liability. So now we have liabilities increasing by that $2,000 deposit amount. But liabilities are still on the right-hand side, so this is similar to the other transaction. It's just that we're increasing liabilities and not equity. In our next transaction, number 5, Circle Films is paying cash to run an ad, so that means that their assets, cash, are decreasing. This decrease in assets results from advertising. So a decrease in assets from operating a business is an expense. Expense, remember, is on the income statement and it decreases net income. So that means it's going to decrease retained earnings. So as a result, their retained earnings and therefore equity is going to decrease because of this particular transaction. In our next transaction, still continuing with Circle Films, Circle Films doesn't receive any cash at the time of this dance competition. Instead, they leave an invoice, and that results in a receivable from that customer. So therefore, Circle Films' assets are increasing. Even though they don't get cash, accounts receivable is an asset. So accounts receivable is going to increase. And since the that receivable, accounts receivable, is generated because they provided a service, then they have additional revenues, as we've seen before, and therefore more equity or more retained earnings. So equity is going to increase, and assets, accounts receivable, is going to increase. So this is similar to what we've seen before. We're just changing the type of asset that increases accounts receivable instead of cash. In transaction number 7, interest is being charged at a 6% annual rate for this new video camera that Circle Films purchases. So similar to a previous transaction where Circle Films purchased equipment, assets are going to increase. So we have more equipment, another $9,000. But unlike in transaction number 2, they're not paying cash. Instead, they're promising to pay cash plus interest in 2 years instead of paying the cash today. So that means we've also got an increase in liabilities, which in this case is a note payable. In our next transaction, Circle Films is exchanging one asset for another. We've seen this before. What happens here is they're receiving cash in satisfaction of the receivable that was created when the service was performed. So this is that customer that we had before who's now paying that invoice. So as a result, cash is increasing and receivables are decreasing. So we don't have anything happening in this transaction with liabilities and equity. In transaction number 9, Circle Films is going to pay their employees. So that means that cash is decreasing by $2,000, which is an asset, so assets are decreasing. Since the payments are an outflow of assets from operating the business, that means that that payment is an expense, which is a reduction to equity or retained earnings. So equity is decreasing and cash is decreasing. Last one. In transaction number 10, cash and therefore assets are decreasing. So they're paying a company's owner, and that's called a dividend. Remember, in Chapter 1, dividends decrease equity, so equity is going to decrease as well. We're paying out equity to the owners, so that decreases our total equity. So let's carry this conversation about this dual nature of accounting to a more formal discussion of the double entry accounting system. A T account, and that's what we've got in the middle of this slide here, because you should be able to see this black T. A T account is a device, or you can think of it as a convention, for organizing and accumulating the accounting entries of transactions that affect just one account. So cash, or accounts receivable, or bonds payable, or additional paid-in capital. So any combination affecting assets, liabilities, and equity can occur, but you got to keep the equation in balance like we've been doing all along. So continuing with this T account, let's talk about the rules of how to use it. The left side of the account is known as the debit side, and the right side of the account is the credit side. So a debit means an increase in an asset. It also means a decrease in a liability or a decrease in shareholders' equity. A credit on the right-hand side means a decrease in an asset or an increase in a liability or an increase in shareholders' equity. So let's take a look at some examples. So in this slide, we're looking at cash. So cash is the account, so we put the account name on the top of the T, and then we've got the debit side and the credit side. So the normal balance for an asset is increased on the left-hand side with a debit. So if cash is received, that's a debit, and it's decreased on the right-hand side with a credit when cash is paid out. Now let's switch over to the other side and look at a liability account like accounts payable. The normal balance for a liability is increased on the right side with a credit, so just the opposite of an asset. So it's increased on the right side or credit side when the company purchases items on credit, and it's decreased on the left side, which is the debit side, when the company makes a payment to its suppliers, when we're specifically talking about accounts payable. Now let's go down to equity. The normal balance for an equity account, like common stock, is increased on the right side or the credit side when the company issues stock to an investor for cash, and it's decreased on the left-hand side or the debit side when the company buys back or decreases the amount of its issued stock, and they'll do that if they want to retire the stock. They just want to have less stock outstanding. So overall, in a double entry system, changes in account balances are recorded according to some pretty basic rules. To increase an account balance, record on the same side as the normal balance. To decrease an account balance, record on the opposite side as the normal balance. And we just went through the assets, liabilities, and equity to talk about the normal balance for all three. So here's kind of a summary chart that just explains, kind of reiterates everything that we've said. We've got each major type of account and how the debit and credit columns are used to increase or decrease those accounts. So assets, liabilities, and equity on the balance sheet, revenues, expenses, and then dividends on the income statement. So for an asset, expense, and dividend accounts, asset, expense, and dividend accounts, increases are recorded in the debit column and decreases are recorded in the credit column. For liability, equity, and revenue accounts, increases are recorded in the credit column and decreases are recorded in the debit column. And then once we get our individual transactions recorded on our T accounts, let's introduce some more terminology that will explain what happens next. A journal is a chronological record of transactions because the journal is where transactions are first recorded into the accounting system. It's sometimes called the book of original entry. So entries recorded in the journal are called journal entries. The ledger is a collection of accounts and all their balances. And then the trial balance is just this line listing of all the accounts and their balances at a specific point in time. So one last thing on just all of these mechanics is that when you're putting together a journal entry, you're going to use this format. At the far left of the journal is a column for the transaction date. To the right of the date is a column to record the names of the accounts affected by the transaction and an explanation. The accounts receiving debit entries are listed first, followed by the accounts receiving credit entries, and you should notice that that credit line is indented just a little bit. To the right of the account names are debit and credit columns to record the monetary values of the transactions. So the totals in the debit and credit columns should be the same for each transaction. Then when an accounting transaction is recorded in the general journal, we typically say that means that the transaction has been journalized. So this is our kind of overall process and the mechanics and the terms related to recording accounting transactions. When we come back, we'll actually make some journal entries.